Hi, everyone, and welcome to the webinar in which we are going to be discussing the response to the International Sustainability Standard Board exposure drafts. So we are going to give a few seconds for everyone to join. I would like to mention that we are going to be recording the webinar in order for those that couldn't join to listen to the discussion later. So we have been working on this, the Capitals Coalition, together with Social Value International and Rosie Danscombe. So thanks everyone for joining. I could run you quickly through the agenda of the session. We are going to be discussing the two exposure drafts. So in the first part of the webinar, we are going to go through the general requirements exposure draft. We are delighted today to have Caroline Clark-Maswell with us and Louise Guthrie that are going to run us through the context for developing these exposure drafts and also run us through the detail of the general requirements exposure draft. Then we are going to have some time for the discussion and questions. So Jeremy Nichols from the Capitals Coalition is going to share some feedback to the general requirements exposure draft, and then we'll have some time for everyone to discuss and ask the questions that they want to pose. On the second part, we are going to follow the same structure with the climate exposure draft. Caroline will run us through the draft, and then we will open the discussion and questions, sharing some thoughts from the Capitals Coalition together with my colleague Rosie Danscombe, and there will be time at the end for some questions. Now. And finally, we will be closing the webinar and sharing with you the next steps. So without further delay, I will hand over to Caroline that will run us through the general requirements exposure draft. Thank you,
Marta.
Yes?
Sorry to interrupt. We can see your screen, but it's not on presentation mode. Are you able to?
Okay, let me try again. Sorry about that.
No problem.
So you missed the agenda, or did you manage?
There we go. We can see it perfectly now. Thank you.
Okay, perfect. Good. Thank you very much, Ben. So with this, Caroline, please, the floor is yours. Thank you very much.
Thank you very much. And just to say, I will now be running through the general, sort of the broader context and general requirements part of this presentation. I just want to very quickly provide the context of sort of then my and Lois's role. So I am the project lead on the climate standard. So that's really what I know in detail, but obviously I've been very closely linked to the general requirement standard and been involved from the start when this was originally a group of 5 paper. But I've then got Lois with me, who was more directly involved in the general requirement standard in order to provide any additional context and depth that I might not necessarily have all of the information for. So hopefully we'll be able to provide you with a sort of combined team efforts, as the project lead currently for the general requirements is down with COVID. So that's the world we're living in at the moment. So if you could please go to the next slide. So the first slide here, we typically just quickly cover because it gives a little bit of the background of the IFRS Foundation and why it's so exciting to be here today. So the IFRS Foundation was established in 2001 with a mission to develop accounting standards in order to bring transparency, accountability, and efficiency to capital markets around the world. And that mission was in many ways one of the reasons why the IFRS Foundation was such a good fit with what sustainability-related frameworks and standard initiatives wanted to achieve, and what we now very much hope to achieve through the ISSB. So the mission today is to develop IFRS standards, whether these are accounting standards or sustainability disclosure standards, that bring transparency, accountability, and efficiency to financial markets globally. And it's worth saying that since 2001, IASB has been adopted by 140 jurisdictions. And so similarly, the ISSB aspired to become the de facto global baseline for sustainability reporting. And we'll talk a little bit more about what that means. But if you go to the next slide, Marta. So the formatting has gone a little bit off here, but this slide is very much trying to lay out the focus of the ISSB. So the ISSB is focused on developing standards for a global baseline, which is a word you're going to hear repeatedly today, as well as the digital taxonomy, which will enable electronic tagging of disclosures. And this is very much with the aim of meeting investor information needs. So as stipulated in the IFRS Constitution, the IFRS accounting standards and IFRS sustainability disclosure standards have the aim, therefore, of providing decision useful information to investors. We hope that this will enable companies to provide a comprehensive sort of baseline of sustainability information for the capital market specifically. And finally, we do hope to be part of what we call a building block approach, which very much is trying to recognize that sustainability disclosures for financial capital markets are not seen in isolation. And we hope that a building block approach can enable the facilitation of additional requirements that are jurisdictional specific or aimed at other stakeholders. So if you go to the next slide. So this slide is very much building on that last point, and some of you might have seen earlier versions of this slide, and it's trying to visualize what we mean with the building block approach. So the outer square, which I think is the most critical part to start, is it looks at the wide universe of sustainability reporting, which by nature has a multi-stakeholder audience. And then the middle square, which is the one that's highlighted in red, is a subset of this, which focuses on sustainability-related disclosures to investors. And then a subset of that, again, is looking at the sort of financial information reported to investors. Importantly, these squares use dotted lines to demonstrate dynamic materiality, which is this idea that sustainability information that today may only be relevant to broader multi-stakeholder audience can become relevant to investors over time. For me, one of the reasons why it's so important to go through this slide, or two of the reasons, sorry. So one is that the two smaller boxes deal with reporting to the same user group, so investors and other participants in the world's capital markets. And that's why it's such a good thing, in my view now, that the ISSB is housed together with IASB under the IFRS Foundation. And the outer box is the second important part of this slide, which shows how connected reporting to investors on enterprise value is with wider sustainability reporting, and thus jurisdictional initiatives and GRI. So you will have seen some of the, if you follow the foundation, you will have seen some press releases that come out in terms of launching a jurisdictional working group. We've got the SEC, so the Sustainability Consultative Committee, and we have an MOU with GRI. So we go to the next slide then. This is just a slide to say that the things we're going to cover today are the two proposals, the two first proposals that ISSB published. One that establishes a general requirements to report on all of an entity's significant sustainability related risks and opportunities, and one which looks at climate related risks and opportunities. If you go to the next slide, please. Okay, thank you. So the general requirements document provides the basis for what we call the global baseline, because it sets out the overarching requirements that an entity provide information on all significant sustainability related risks and opportunities. And this was developed partly because some of the market feedback that the trustees got to their consultation was that, yes, climate is an incredibly urgent and important issue, and we certainly want to see develop a standard here as soon as possible. But there's also this strong sentiment that other sustainability related issues are critical, and also that climate cannot be seen in isolation. So some of the history of why the general requirement exposure draft sort of came to fruition. So if you go to the next slide, please. So this slide is just taking a bit of a step back and looking at what we call the broader standards architecture. So if we start on the right-hand side, you will see the sort of relationship between this overarching general requirement standard and the thematic and industry-based requirements that deal with specific themes and or industries. And so the climate standard is the first example of such a standard, and as you will recognize, that's a thematic standard that includes cross-industry requirements, but also include industry-based requirements. And on the left-hand side, for those of you that are familiar with the Task Force for Climate-Related Disclosures, you will recognize the structure that these standards use with governance strategy, risk management, and metrics and targets is based on the TCFD structure. So you go to the next slide, please. I've included this slide despite the need for kind of going through some of this quite quickly, because it's it's one where we probably haven't done a good enough job of explaining some of the logic. But one of the things that the standards focus on are significant sustainability related risks and opportunities. And some people ask, hang on, how does this work together with materiality? And the idea was that when the technical readiness working group, which developed the prototypes that now have become part of the exposure drafts, did some targeted outreach, a lot of entities said, hang on, you know, it's just all sustainability related risks and opportunities is a really, really massive ocean of things that we don't quite know. And the idea was to help them understand in a way what material actually mean, which is what investors are looking for are the sustainability related risks and opportunities that really matter. So it's all almost translating that sort of financial term of materiality as a starting point for entities. And then of course, the information that is disclosed at the end of the day must be subject to materiality, which is not an entity level. Sorry, it's not the preparers that decide what's material. That's obviously the decision there has to do with whether it omitting it or misrepresenting it could change the decision of an investor. And as part of this discussion, the other thing to mention here is that people very often might say, oh, the standard don't include impact or any sort of impacts of the company on people, the environment, and the planet. And I think what's important and what we definitely seek feedback from you guys, particularly with your expertise, is that the idea is actually that it should include impact. If, as an impact the company has on people, the environment, and the planet, if they affect or are reasonably likely to affect enterprise value. So it's that sort of second order test. And that's also, if we go back to the squares earlier that we were talking about, that sustainability related risks and opportunities is a subset of the wider sustainability landscape. So if you go to the next slide, please. There's a lot of things we could talk to about the general requirements, but just to kind of talk about a few more key features. So first, it emphasizes the importance of the package of information provided to investors by emphasizing the link of information both within the sustainability related disclosures, and you'll see quite a few paragraphs that sort of deal with that, and also between those disclosures and the financial statements. And importantly, when relevant, assumptions should be consistent between the two. It furthermore aims to bring sustainability reporting into the mainstream by requiring that financial statements and sustainability related disclosures be provided at the same time. And this is very important in terms of facilitating assurance for sustainability disclosures and to emphasize that consistency and connection, which is the first key feature. And then finally, just to go back to global, so in order to support global adoption, the general requirements exposure draft proposed that the sustainability disclosures be provided as part of the general purpose financial reporting, but does not dictate specific locations. So we don't want it to be inconsistent or in conflict with specific jurisdictional requirements about location. And also it does allow that information beyond what is required by the general requirements can be provided within the sustainability disclosures, as long as this does not obscure or clutter the information required by the general requirements exposure draft. If we then go to the next slide, thank you. Again, apologies that the formatting has come out a bit weird on some of these slides. Hopefully you're still able to follow, but this is the final slide of the general requirements section, and it's just to talk a little bit about how an entity can go about providing information on all their significant sustainability related risks and opportunities when the ISSB currently has only published one thematic standard, which is for climate. And so what the general requirements exposure draft tries to explain is sort of the order of logic here. So in the first instance, an entity should use specific ISSB requirements. So at the moment, this could be the climate document once that's published. And in the absence of specific ISSB requirements, the general requirements exposure draft proposes that an entity use the SASB industry-based requirements, the CDSB material, and materials of other standard setters that have the requirements to meet investor information needs, but also industry practice. And the idea here is to both enable an entity to identify sustainability related risks and opportunities, that are likely to be relevant and material, but also to develop appropriate disclosures for that the entity can use. So I think it's time to pause for now and hand the floor over to you guys.
Thank you. Thank you very much, Karen, for running us through it and giving us the context. So, Jeremy, now it's your turn to share with everyone the high-level feedback. And please, everyone, start feeling free to post your questions on the chat, or then you can unmute yourselves and ask the question. So, whatever you prefer. So, Jeremy, the floor is yours.
Thanks very much. The high-level bits are quite high-level, and so perhaps we can run through these and then come back to the questions at the end of that. We've also been putting together a more detailed response to all the 17 questions. These represent, I suppose, some kind of focus of our thoughts on those. And the intention is we'll come back to with the next steps to share both a high level and the longer set with you all. But we thought it was, I think, very useful to have that framing from Caroline to kind of, I think, reflect the sense of our response, which is actually as much, if anything, about the relationship between ISSB and IASB. And appreciate that while the exposure draft is a reflection of IAS 1 and 8, our comments are probably more a reflection of the alignment with the conceptual framework for financial reporting, which sits by my bed. And I suspect, as our understanding is, that at some point you will be considering generating a conceptual framework, and so some of our comments may be of use to that future, but are therefore in the sense of potentially avoiding any problems now that might emerge later, and are intended within that. And I suspect also that you are getting or will get a number of comments which are about the scope of the standard. And the three boxes, and the bulk of our comments are really around the existing scope and within the context of those first two, and therefore the relationship between them. And that may end up being a little bit geeky, and I'm always nervous consequently, because this is stuff that you live and breathe, and we kind of come along to as enthusiastic amateurs in a sense. But within that context, I'll kind of nip through the kind of high-level thoughts that we had been thinking about. So the first one, I think, in the relationship between IASB and ISSB is that they both got the same audience, and they're both therefore constructing what is useful information for those. But it would appear that there is a difference in the level of certainty that may be required for recognition, or let's say first disclosure, rather than recognition. So disclosure under either ISSB or IASB. In other words, that there is the likelihood that things that may affect an investor's decision around sustainability may affect that decision with a lower level of certainty than the things that currently are expected to affect their decisions if they are being reported under IASB. That may not be true, but it certainly seems to us from the reading that seems to be what is emerging, a difference in the level of certainty. And if that's the case, I think it would require some further explanation of why and how that's the case, because it would seem a bit inconsistent and potentially risky, therefore, to have two levels of what is certainty for the same user, still addressing in the end the effect on assessing future cash inflows into the enterprise. And that is one of the potential inconsistencies that might give rise to uncertainty from the users, who are then saying, well, hang on, which is which on this? And is there therefore information that you are now not disclosing under IASB, which, if it had the same lower level of certainty as is considered useful under ISSB, would actually be useful to me? And that therefore you risk excluding useful information under IASB by having a higher level of certainty under IASB, if that makes sense. So that is our first kind of reflection. The second one, it relates again to useful information and is about management stewardship. And obviously the conceptual framework for financial reporting says that the user will require two types of information, one about the economic resources that the entity is using, and the other about management's stewardship of those resources. And to some extent, you can read the first as being the balance sheet and the second as being the profit and loss account. And the profit and loss account in that sense is a reflection of the historic management's decisions, where effectively they've been making trade-offs between different options, and that the result of those trade-offs is this level of financial performance being reported. Currently, as we understand it under the exposure draft, the recognition of trade-offs is there, and the governance section suggests that the way in which the governing body thinks about those should be being reported, but the actual quantification of those trade-offs is not. And that appears also to give a potential inconsistency between what is useful information under IASB and what is useful information under ISSB, because to be useful under IASB, we are expected to quantify those trade-offs, and the report on those quantification is your profit and loss account. Whereas under ISSB at the moment, we're only reporting on the process by which we look at those trade-offs rather than the quantification. And again, therefore, there appeared to be a potential risk of two different levels of understanding what is useful information. And again, that could cause uncertainty for users. And even though we recognize the challenges in that, I mean, you are probably a group of people who thoroughly support and believe in the ability to quantify those trade-offs, and much of our work under SVI and the Capitals Coalition is approaches to doing so. But recognizing the challenges from your perspective on that, it might at least be useful for perhaps to give a sense of the direction that you are planning to bring those two into alignment. Thank you. And then perhaps a bit more of a kind of detail one. To the extent that ISSB covers both the historic decisions, to the extent that management decisions are having an effect on sustainability issues, and those are relevant to enterprise value, but also that there are external effects on enterprise value which relate to sustainability topics. Again, potentially gives a slight difference to IASB, which is only interested in historic management decisions. And I think it would be useful to make sure that any disclosures under ISSB separate those out really clearly. And we weren't sure from the exposure draft whether that separation was actually being explicitly required. But I think for those users who want to be able to read across which of this is comparable to the IASB financial statements, they would need to know the sustainability bits which are the result of management's historic decisions separately from the external impacts on enterprise value arising from wider sustainability issues. So that's the first set. The second one is about the structure, because the structure, as you've said, at the moment largely follows TCFD, and quite a fan of the structure under the conceptual framework, to be honest. And again, if that's the same user, then the question would be, I think, why not use that structure? Now, that structure very much talks about relevance and faithful representation. And whilst faithfully represented is used as a term within the sustainability exposure draft, it's not exactly the same when we talk about faithfully represented, and it's not exactly the same structure of the two then followed by measurement. Also, the way in which uncertainty, aside from our question about the different level of it, the drivers of uncertainty under the conceptual framework are, for financial reporting, are existence, outcome, and measurement uncertainty. And they are seen as separate, whereas they're slightly nested in a different way within the sustainability exposure draft. And again, that gives rise to a potential inconsistency in how people are expected to think about those different types of uncertainty. And although we understand that the kind of clear blue water between the two relates from the fact that under ISB, we're very interested in what are conceived of as assets and liabilities within those levels of uncertainty. In other words, things that the organization, economic resources the organization has control over, and any potential reductions of those resources because of liabilities, that in some way that does not relate to the issues that are being reported under sustainability disclosures. We feel that there is an overlap between the two, and particularly more likely to be an overlap under liabilities, and have, as the Capitals Coalition, have actually done a separate piece of work on this under disclosing impacts on the financial statement, specifically to explore that overlap. And so again, for those reasons, if that structure is not being followed, we think it would be useful to have some explanation of what and why, and then are there any implications of that difference, so that a user can be clear and get the read across between the financial statements and any sustainability disclosures now being made at exactly the same time, which of course would be brilliant. And again, that kind of I think it's similar to all of these. I think is that if these are differences, then they present a potential risk to the person wanting that useful information, because that discrepancy can make things less useful overall, and that's the thing to try and knock on the head earlier rather than later, we felt. Thank you. Next up, Marta. This also then flowed into another one around the kind of language here around what comes up under the conceptual framework for financial reporting, which is primary users. And primary users are existing and potential investors, lenders, and other creditors. Whereas under the ISSB at the moment, we're talking largely about investors and people who are active in capital markets. And so it'd be interesting to know why why lenders and other creditors are not considered to be users in the same way, and whether there are any implications. In other words, is there information that's being disclosed under IASB to meet the needs of lenders and other creditors that would not be equivalently being disclosed as a part of a sustainability disclosure? Or is this a simple slip of the kind of tightness of the language? Part of this, we think, is an important opportunity to perhaps clarify some of the issues that are actually coming under IASB first, rather than leaving them unclear to at least me, if not others. And that is the definition of the word potential, for example, because who is a potential investor has massive implications for what would be useful information. And we can consider potential investor as someone who has economic resources and is about to invest them, or as someone who might have those economic resources at some future point and would then invest them. And I think some clarity about both the language that's currently in IASB and how that reads across to ISSB would be extremely useful for those of us who are kind of trying to see the relationship between the two. And we understand that there's plans for a working group to look at some of these relationships in future as well. And so maybe these thoughts will help inform the work of that group. And finally, you'll be glad to know, is, well, it's not quite finally, it's nearly finally, is this, but it starts to get into the relationship between double and financial materiality. And I think our perspective on that is largely that from an assurance point of view, if you were to give an opinion on the completeness of the information being provided as being the information that is materially relevant from a financial perspective, the only way you could assess the risk of misstatement would be to understand what the wider set was. And we're perhaps a little bit more optimistic, Caroline, about the ability to get your hands around that. And also the process by which the entity has gone through in order to prioritize within that wider list to the ones that are financially material. And so we feel to some extent the debate is a little bit of a kind of, because surely from an audit perspective, you're going to need to know what that wider set is anyway, even if it's not being disclosed. Although it is interesting that the Australian Accounting and Auditing Standards Board and the Assurance, well, there's 3 A's in there, there are 2 boards, the Accounting, Auditing and Assurance, split accordingly, have argued for the disclosure of the full set of material issues in order that the user can assess whether the filtration or prioritization is okay or not. But one way or the other, we think that when we get into the assurance opinion, it could be a way of resolving some of these debates because we're going to have to know it anyway. That does lead us into the kind of the last bit, which is, I suppose, our bit of a reflection on the wider question. And it goes back to this idea about the investor. We've used the word reasonable under the use of reasonable estimates. This is a read across from the conceptual framework for financial reporting. We are wary of the use of reasonable as a few kind of adjectives that get dropped into all of our documents without necessarily being defined. And what is reasonable or not reasonable is quite a dangerous one, I think, not to define. And so we do think it would be quite useful to go, well, whose reason is that's being determined here, and who gets to define reasonable? But it also made us reflect on that wider question, really, of there is an assumption here that investors are only interested in the financial consequences and the effects on their cash flow, inflows, and the financial returns. And whilst that is, of course, a read across from the conceptual framework for financial reporting is hardwired in, I think it's fair to say that the trustees have stated that they expect the information to be useful for the maximum number of users. They recognize that other users would have other interests than just the financial returns. And they are trying to create standards which reflect the interests of the maximum number of users. I think it's time to perhaps pause before we hardwire that back into the IASB to think, is that still really the case? Is it the case that those investors are only interested in those issues? And is it indeed reasonable that they might be? Because given the state of those wider consequences at a kind of system level, it's hard to see how those wider external effects that enterprise has on others, even if they have not been seen to be affecting enterprise value today, or maybe in the next 10 or even 50 years' time, nonetheless remain important to sustainability of the world more generally. And it's about, and maybe we should reflect on the use of reasonable at that kind of wider level, which is about as far as we go to the third box, I suppose, in the original scope. So there you go. That's our headline points for everybody. Over to you for your thoughts, reflections, comments, critiques.
Thank you very much, Jeremy. I stopped sharing so that we have a bit of opportunity for discussions in our faces. I don't know, Ben, are there already questions on the chat or from the audience? Otherwise, if Lois or Caroline want to.
Silence, Martin.
No? Silence. I don't know if Lois or Caroline, based on these thoughts, would like to share some reactions. I think that there is one question coming.
Marta, just to say we're happy to share reactions, but if people have questions, I think for us it's even more important to be able to use this forum to answer questions. So if there's a question now,
I can see one from Diana. So what is the difference between TCFD and this framework?
And that's a very good question. I'm very happy to answer. So the basis for the framework is TCFD. So as Jeremy said, the structure that you will find in terms of governance, strategy, risk management, and metrics and targets, that's very much based on the work of the TCFD. One of the if you think of that as a starting point, the first question we had to ask ourselves was what does it take to move that from a voluntary set of recommendations specifically for climate to something that can be part of standards that would be adopted by jurisdictions worldwide. And so a lot of the changes are to increase the granularity of the disclosures so that they're easier to assure, for example, or to be verifiable, which then goes with assurance. And so on. And I think obviously the other natural thing in terms of sustainability. So see, that's primarily what we've done for climate, and then for sustainability, also kind of baking in anything that is more widely to do with sustainability related risks and opportunities. And Jeremy, I can tackle on one of the comments that you made in terms of the structure following TCFD, and you're a fan of the IASB structure, which is a great point, and very much to say that everything is obviously subject for comment, and this is more sharing the initial thinking. One of the things with TCFD, I think this is one of those areas where we've tried to thread the needle between what is already globally adopted and understood in financial reporting, and also what is already globally adopted or used in sustainability. And one of the advantages we see at the moment by using TCFD, not to necessarily diminish that point, Jeremy, is that it gives us a bridge to some of the jurisdictional initiatives. So at the moment, the SSC is relying quite a lot on TCFD. We see some of the more regional work coming out from other jurisdictions, and EFRAG is also building on TCFD. So it kind of allows us that slight bridge and hopefully a good starting point. So one of the things that we, of course, are very concerned about is making sure that if this is going to be a useful global baseline, this is information that preparers could use, and then they could supplement it with jurisdictional specific requirements. I think it'd be a very bad scenario if we ended up having a very different set of information being reported to each region alone, and that there was no sort of global baseline of comparable data that preparers could build upon. And sorry, just one other thing that I keep forgetting when I answer this question. There is on the IFRS website, and let me see if I can grab it. There is a comparison document between, or that shows how the TCFD is different and similar to, or how we built out from the TCFD requirements on the climate standard. I don't actually think we have one for general requirements, but it is very similar. So let me see if I can grab that whilst we get some other questions in. It's a helpful document. It is relatively high level, I would say. And if I can't find it now, so I should probably engage in this webinar, but I can see if I can send it to you guys later and then you can circulate it.
Thank you, Caroline. So the reaction from Diana is if the companies will have to disclose to this framework, TCFD and GRI, that is a lot of work, isn't it?
Yeah, it's a good question. So TCF, I mean, this is where I need to make sure that I state this is a personal observation rather than necessarily, you know, the IFRS needs to be very careful about what we're saying in terms of what will be the reality. But because the TCFD very much is what's grounded the work of these standards, I think you should be able to fulfill the requirements of TCFD when you fulfill the ISSB requirements. GRI is separate, so they're addressing a broader stakeholder audience, and this is where we go back to those nested boxes essentially, where, you know, ideally, again, we have a collaboration with GRI because we ideally want to make sure again that these standards are interoperable, and what that means is if you're addressing the, you know, trying to meet the information needs of investors, you can use one set of disclosures and that would kind of work to both fulfill the requirements of GRI and the ISSB. And if you then want to just tag on specific multi-stakeholder disclosures, that wouldn't be something that the ISSB does. It's not part of the remit of what the ISSB does, but you then have the GRI disclosures to supplement on that. Now, that's something we're looking into. So we're having a collaboration with GRI at the moment, which Lois actually is leading. So Lois, if you want to come in and supplement on that.
Yes, just briefly. I mean, one thing we have noted in our discussions with GRI is that there is a core set of information that is equally applicable to assessing an enterprise value and to assessing impact. So greenhouse gas emissions is a perfect example. You can discern from that how enterprise value might be affected, what the magnitude of risk is, both to the company and to the environment and society. There is that core set. And then it's a question of determining to what extent can the same core set of information be used to satisfy the requirements of the ISSB and GRI, and to the extent that there are differences, how are they to be described? Now, having come from the World Business Council for Sustainable Development, I love examples. And if you were to have a look at CLP's reports, that's the Hong Kong Electric Utilities Company, CLP, you'll see that they have a very nice, neat diagram in their sustainability report explaining how there are issues that are material to both impact and enterprise value, and there are some that are just material to the assessment of impact, and they distinguish them in the way I think that you were indicating, Jeremy, that there needs to be this transparency over what is designed for which purpose in your reports.
Thank you very much, Louise and Caroline, for the clarifications, very clear. So there's another question coming from Lara Brooke. What is the difference between SASB and ISSB disclosures?
Another good question, and actually one that I would also probably touch upon when I talk about the climate standard, just because it's a very good example of it. So of course the SASB standards are industry-based metrics, as well as kind of then protocols associated with that. At the moment, when we consolidate, those standards will belong to the IFRS Foundation. They will be published, but they've not gone through the due process of IFRS, and they're very much used as a reference point if you're looking at sort of what sustainability related risks and opportunities are there in my industry, that's one of your reference points. But that is kind of part of the picture of the ISSB. So again, if we go to the climate standard, they have industry, what we call cross-industry metrics, and disclosure topics, which are disclosure topics and metric categories, sorry, to be precise, that are relevant across industries. But they also have industry-based requirements. And unlike, and this is where it can get a little bit muddled, so unlike the SASB standards, which will be uploaded on the website and will be very clearly marked as guidance, there are industry-based requirements in the climate standard in Appendix B that are based on the SASB standards that are tagged to climate, but are also made a few amendments to make sure that, you know, if there's a perception of regional bias, they've been updated through a process that they've run. And those are part of the standard and are part of what we would look at as required disclosures. So what's the difference? Sort of some summary points. They both are looking to meet investor needs. So that's the similarity. The difference is the ISSP disclosures is a set of disclosures, some of which are applicable across all industries, some of which are applicable by industry, and SASB only looks at the industry-based component of that. But both, again, very importantly, are only, you know, you would only be required to disclose it if material. So that's a common misperception that, SASB requires you to disclose this metrics. They don't. Again, it's a starting point for what is likely to be material. And I think that's kind of the key points. I'm sure there are some other things that I could help elaborate.
Thank you, Caroline. So before moving to the climate one, the last question that came in was from Robin Sittle, and she is asking if you could elaborate on how impacts and dependencies on natural, human, and social capital are incorporated. Is it only considered if those impact the enterprise value? And if so, is that then defined, and are there timelines associated with what is considered material to enterprise value? Is one that maybe requires a bit of time.
I think that's fine. I was just wondering, Lois, if you wanted to come in and address that, because I appreciate I invited you to kind of benefit from your experience, but otherwise I'm happy to address.
Yes, I mean, I think it's Robin, isn't it? The questioner is right that the general requirements standard is focused on impacts to the extent that they affect enterprise value. And of course, that is very much dependent, as the question rightly points out, on time horizon. So again, going back to the examples of how companies have dealt with this, if you look at Royal DSM's annual integrated report to 2021, you'll see that they have characterized climate risks as emerging risks. So they've actually reported them, but they're saying that, you know, the effect on the company is going to be some way down the line. They can't determine the time horizon. It's not on their current risk register to deal with. It's an emerging risk. So yes, the questioner is right. Our focus is on impacts insofar as they affect enterprise value, but that might not preclude reporting under this standard, because we ask for the process by which risks are governed and managed. And therefore, I think that explains why some companies are actually characterizing how they define risks, you know, what sort of box they put it in, and whether it's an immediate threat to enterprise value or where it's a threat to enterprise value further down the line. And it sort of speaks to Jeremy's point on uncertainty as well, about, you know, reporting under conditions of uncertainty and how risk management categories can help you with that.
And sorry, Marta, can I just come in very quickly and answer part of Iris's question? I know we're short of time, but I thought it was quite an important one, which asks to come back to the audience definition and how decision useful sustainability information is defined. What are your thoughts about the quite rigid separation between investors and other stakeholders in this conceptually? And you pointed to the fact that there are many examples where interests are becoming more aligned. And I would say, I don't think the ISSP are forcing a rigid separation between investors and other stakeholders as far as we can. Obviously, we're providing decision useful information for investors, but we wouldn't really be here if there was a sort of investors' interests and then everyone else's. It's because of that impact on other stakeholders that I think in many ways we are where we are today. So obviously, like, to give some examples of the transition risks that this standard addresses, some of that is regulatory. And if we were going to create rigid distinctions, that's probably one way you go, well, pricing pressure for carbon pricing, that's quite investor focused. But there's also reputational damage, there are other resource concerns as well. Like if you are a high emitting company, are you able to attract the talent that you are today? So I think there isn't I think it's a narrative we're fighting quite hard. I don't think there is such a rigid line, and it's an unhelpful narrative in what we're hoping to achieve.
Can I just add in on that it's why are the issue around potential investors so important? Because at its widest, if potential investor is anyone who might become an investor, it's everybody already. And so you immediately get a multi-stakeholder approach if potential is as broad as it could be. And so the extent to which there's a rigid separation or an overlap, I think hinges a lot on how potential is being defined, which might seem fairly geeky as a kind of single word, but I think it goes to the core of this issue of what is the separation, because obviously you could be in more than one camp. You can be an investor and one of another stakeholder group, and you can certainly be a potential investor and in another stakeholder group. So the read across from potential investors is important.
Thank you so much. This discussion is fascinating, but we wanted also to run you very quickly through the climate exposure draft. So I can see that there are more questions coming. I don't know if Lois, if you could respond to the question in the chat. Meanwhile, Caroline is running us through the climate one. Thank you.
And also, Marta, feel free to kind of if you guys can compile the questions, we're happy to look at them as well separately. Okay, so the first slide, in the interest of time, I'll cover that one very quickly. The idea here is just, we typically pause when we do these sessions and talk about why we've had such a strong feedback for the market in terms of climate being such an urgent issue. And so needless, I'm sure all of you have seen versions of this before. This is from the IPCC looking at the projected greenhouse gas emissions, and the orange line is, where we're heading based on current implemented policies, which is quite daunting when you look at the different pathways that is needed to limit global warming. So if you go to the next slide, when we go into the climate standard itself, the climate exposure draft requires information to be provided about significant climate-related risks and opportunities, which we touched upon briefly, but it includes physical climate risks, which we often think of as acute or chronic, which is similar to the TCFD recommendations, with acute being things like flooding risks, and chronic can be temperature rises. Transition risks, which are risks associated with the transition to a lower carbon economy. So we talked about the effect of regulation versus, for example, reputational damage. And then climate-related opportunities. And we often talk about the fact that climate-related opportunities can both include what I think a lot of companies want to position, which is the sort of way of mitigating climate change, so renewable energy companies, for example. But it also has to a certain extent to do with adaptation and changes that are happening because of climate change that are maybe less popular to talk about. So if you're an air conditioning manufacturer, then rising temperatures are an opportunity presented to your company. So if you go to the next slide, please. This slide, I think we did actually cover quite a lot in the Q&A. So this is where we try to talk a little bit about how it is consistent or building upon the TCFD requirements and the SASB industry standards. The only thing I'll touch on, as I said, so in the standard, the climate standard or exposure draft, the SASB standards or sort of the industry-based requirements that are built on the SASB standards are a required part of it, and you can find it in Appendix B. There are two changes versus what you would find in the SASB standards. They are highlighted where those changes have happened in order to facilitate kind of easier comments for people already familiar with the SASB standards. So one is to update metrics that might have had a regional bias previously. And the second is that as the market has evolved and matured, we've added disclosures on finance and facilitated emissions for the financial sector. So if we go to the next slide, please. So just like with the general requirements, it's worth just highlighting a few of the key proposals in the climate exposure draft. So one is around transition planning, which is covered in paragraph 13, 21, and 23, if I remember correctly. So it's not like one neat bucket, but primarily 13. And the exposure draft proposed quite extensive disclosures about a company's climate transition planning, which includes its emission targets and how it plans to achieve them. Importantly, it does not mandate companies to have a transition plan, but it lays out the disclosures that you would expect an entity to disclose if they do. So for example, if the entity has a net zero target, how is it planning to kind of resource the target to make sure it is achieved? What does the target consist of? Like how much of that is emission reduction versus carbon offsets? And if it's using carbon offsets, some more information and transparency in terms of what does that is that a natural or technological offset, is subject to certification, and so on. And the intention is very much for investors to kind of be able to understand, the entity's plans to respond to climate-related risks and opportunities, as well as to form a view on whether these plans are achievable. Climate resilience is the second one, which is where you find scenario analysis, which is a popular topic when it comes to climate change. And this disclosure is really designed to enable investors to understand how an entity is planning for different scenarios and how they're undertaking the analysis. Importantly, one of the things we're grappling with is how do we make sure that this standard is able to reflect the fact that smaller entities might be less set up to do this already. Emerging markets might struggle more, and also industries that have less use to climate reporting, whilst not providing a loophole and incentivizing people never to disclose this information. And one of the things we therefore have in terms of language is that an entity use climate-related scenario analysis to assess its risks and opportunities when it is able to do so. But it also addresses alternative methods an entity can use if they are unable to do so. And that's quite an onerous disclosure requirement, but it ensures that if the entity is genuinely unable to do so, it has other alternative methods that hopefully provide useful information too. And the entity will also have to disclose why it is unable to do so, which is slightly different from what we typically see with IASB. And then finally, the exposure draft does propose that an entity disclose their scope 1, 2, and 3 emissions, calculated in accordance with the greenhouse gas protocol. And I think it's time to pause there, but actually if I can just very quickly say one thing on the next slide, which is, please, I know you guys are preparing a comment letter, so that's very much appreciated. Just a reminder that the comment letter period closes on the 29th of July, and we are keen for as much feedback as we can possibly get to make sure that we act both in an informed manner, but also in a quick manner as well.
Thank you so much, Caroline. Yes, we would like to have as much response as possible. So we would like also to share with you some high-level reflections on the climate exposure draft. I will go quickly through it because we are running out of time. So we think that the approach is sensible and will ensure that climate impacts and dependencies are well accounted for. In particular, we welcome the approach to assess the gross impacts. We agree with the approach of in those cases in which quantitative or model information is not available for the assessing the impacts and the dependencies, that it's good to use qualitative data instead. So in terms of suggestions, we'd like to suggest that there is a better integration of additional benefits coming from nature-based solutions. So this type of solutions are providing benefits in terms of tackling climate change, but also have additional benefits. So how to bring all those benefits and be able to disclose about them. We think that having a classification of risk and opportunities that mirror each other would be beneficial, because an opportunity is a risk that is well managed. So that's why, for example, that the reputational risk is appearing as a risk, but not as an opportunity. So that's why we think that mirroring the categories will be helpful. We encourage the use of the social cost of carbon to value the impacts from climate change. This will help the preparers to understand the magnitude of the risk and opportunity. So it would be an opportunity to have it in the draft. We also encourage to have some clarifications on how to handle voluntary offsets with regards to additionality. So this kind of offsets, this is a space that is really very complex and is not well regulated. So the more clarity that you could provide to preparers, it will be helpful for them to implement it, and also for the users to understand what is the kind of information that is useful for them. And finally, if we identify that there could be a potential conflict in the scope of organizations that are disclosing information under the scope of the IFRS accounting standard, and also on the IFRS sustainability standard. So this is referring, for example, to the case of disclosing on the scope 3. So the more clarification about this potential conflict, the better. So these are mainly our comments. I think that unless there is a burning question or any reaction, Ben.
One to add, Marta, if I can quickly.
Yes, please. please.
It goes, but it was the transition planning issue because it raises another example of the relationship between IASB and in this case, the climate standard as an example. So if you have a transition plan and to deliver by, let's say, 2030, and you are falling behind your plan, then there is an argument that you should be constructing an obligation under IAS 37 and at least disclosing that, even if not recognizing it on your balance sheet, but at least disclosing it. The argument against that is that you don't have to disclose the obligation until the day before you failed to achieve your target. So if you set your targets as an annual series, so it's not enough to have a transition plan for 2030, you should have that broken down by year and be performing against that. And I think it'd be useful to require plans to be detailed at the level of the reporting cycle, rather than a kind of overall, well, don't worry, by 2030, we'll have sorted it out. That's all.
Thank you, Jeremy. I couldn't unmute myself. Rosie, any other thoughts, reflections? You have been also working on this.
Conscious of time, I have just one additional thought on the inclusion of Scope 3 GHG emissions. So and with this, there's always two sides to any story, and I think it would be fantastic to have the inclusion of Scope 3 emissions in the disclosures, but I do have concerns that, whilst we are increasingly seeing companies calculate Scope 3, the robustness around data inputs and calculation techniques is still lacking, and I think that's something that's kind of much discussed whenever we talk about Scope 3. So I think that would lead to concerns for me around, firstly, I think presenting a barrier for some organisations to adoption, but also questioning whether it actually does provide useful information to investors and potential investors if we're saying that this is still an emerging area with the robustness in question. Then it just says to me, is this providing useful information or is it a barrier to uptake? And it's probably a little bit of both to me, which says that we just need a bit more thought and consultation, and I'd welcome other views as well that you receive in the consultation on that point.
Thank you very much. I don't know, yeah, unless there is burning reaction. Caroline, I see that you muted yourself.
I think that, thank you very much, Rosie, for the comment in question, and I think you accurately summarised some of the things that we're grappling with. And so, all I would say right now, in the interest of time, is we encourage responses to the consultation, and it's certainly something on our mind. We hear probably both. We hear investors that say, don't let, we'd rather have the increase in certainty. In this case, to Jeremy's point earlier, and for us, it's very much about figuring out at which point does this become too uncertain for investors. So the more we can hear from investors in this, as well as preparers. And again, another thing that's very much on our mind is not just the challenges, but how those challenges are unevenly distributed between smaller companies and larger companies, and companies in emerging markets versus companies and sort of more developed economies and so on. So thank you very much for your comment.
Thank you very much, Caroline. So yeah, before closing, we wanted to explain you about the next steps. So Bernie, if you could, sir, we are going to be sharing through a Google Docs the response. So everybody, we encourage you to provide us feedback. It's going to be open till the 1st of July for you to add comments. We are going to be adding the cover letter on Monday to the questionnaire and to the high-level comments, the climate change one. So then we will be incorporating all the feedback from the community, and finally we will make the final response available for everyone to be used to input into their own responses. As Caroline mentioned, the consultation is open till the 29th of July. So yeah, we encourage everyone to respond to the consultation. And with this, Ben, if you want to say a few words for the closing.
Oh, thank you, Marta. Yeah, just on those last steps, we encourage everyone to get involved. Please do share the link when we send the document. The more people piling into this, the better. But I just want to finish by thanking everybody who joined the call today. The speakers, fantastic, a brilliant conversation. And thank you all. And I look forward to working with you as we respond to this exciting consultation. So thanks, everyone.
Thanks, everyone.